Hey guys, hope you are all having a fantastic day. Sorry I've been gone for the past couple days. I had some things come up and couldn't find time to keep pumping 2 to 3 videos per week as I was doing. Now that things are back to normal, we can get back in on track as we had been. Today we are going to retouch on a story I spoke about over a year ago in regards to Wall Street's never-ending hunger, and its direct corrosive effect on society as a whole. More so, we intend to focus on Wall Street's keen obsession with their fiduciary duty, and the disproportionate attention over it that results in weaker regulations, risky business practices, worse services and products for customers, and increasingly worsening employee treatment. Yes, I am a capitalist at heart just like most of you, but I do also understand that there are extremities that we as a society must come together to acknowledge so that we can push for better legislation that protects us all while simultaneously nurturing a rich economic ecosystem that allows companies to thrive. This video was the culmination of a lot of research, and it had to be delayed multiple times for me to put it together. However, I hope the length of the video makes up for my absence these past 2 weeks. Before we begin, I quickly want to invite everyone here to come join my Discord. We alert today traders, weekly trades, and long-term investments. We have a strong community there, so don't miss out. Click the Discord link in the video description. Now, let's get started. A lot of this video was inspired by the Harvard Business Review and a great journalistic publishing by Gautam Mukunda, so shout out to them. Repeatedly, corporate leaders consistently make decisions that do not prioritize the best interests of their companies, succumbing to pressure from Wall Street. While it is commonly believed that these choices are driven by a fiduciary duty to maximize shareholder returns, it is important to note that U.S. executives are not legally bound by such obligations. Nevertheless, the overwhelming power amassed by Wall Street makes it challenging for executives to resist its demands. Over the past few decades, legislation that once imposed controls on Wall Street has been largely dismantled, leading to a significant increase in the size and profits of the financial sector. Consequently, Wall Street's influence has grown immensely, specifically in its ability to sway the government through substantial spending on lobbyists and political contributions amounting to billions of dollars. Even in the aftermath of the financial crisis, Wall Street managed to impede and dilute new regulations intended to curb its high-risk practices. The phenomenon of financialization in the economy carries significant disadvantages. It amplifies volatility, hinders growth, and misdirects valuable resources, including talent and capital, away from generating wealth and towards redistributing it. Moreover, it distorts rational thinking. Re-establishing a balanced power dynamic is crucial for the competitiveness and overall well-being of the remaining sectors of the economy. Implementing measures such as restrictions on the scale and leverage of banks, as well as modifications to the tax code, could encourage a more favorable equilibrium. However, implementing these reforms will require a lot of social activism. Let's talk about one of the biggest and most important events that perfectly illustrates what we are talking about. Boeing encountered significant challenges during the launch of the 787, including substantial cost overruns and battery fires. While technical issues can occur in any product, what sets the 787 apart is that these problems originated from the very decisions that Wall Street encourages executives to make. Before merging with McDonnell Douglas in 1997, Boeing had a culture driven by engineering excellence and a history of taking bold risks with innovative aircraft investments. In contrast, McDonnell Douglas prioritized risk aversion, cost reduction, and financial performance, which ultimately dominated the merged company's culture. Despite objections from experienced Boeing engineers, the development of the 787 involved an unprecedented level of outsourcing, partly driven by the desire to maximize Boeing's return on net assets. While outsourcing reduced assets on Boeing's balance sheet, it also created a highly complex supply chain for the 787, compromising the company's ability to maintain the stringent quality standards required for an airliner. As predicted by the engineers, this resulted in significant delays and skyrocketing costs. Boeing's decision to minimize its assets was motivated by Wall Street considerations. Financial analysts rely on RONA to assess managers and companies, and the fixation on this metric has influenced the decision-making of numerous firms. Research conducted by economists John Asker, Joan Fair-Mensah, and Alexander Youngquist reveals that publicly traded companies, driven by the desire to maximize short-term stock prices, invest only about half as much in assets as privately held counterparts. The pressure to reduce assets led companies like Sara Lee to shift from manufacturing clothing and food to brand management. The CEO of Sara Lee explained, "Wall Street can wipe you out. They are the rule setters. And they have decided to give premiums to companies that generate the highest profits with the fewest assets. In pursuit of higher stock returns, many electronics companies, following the footsteps of Boeing and Sara Lee, have outsourced their manufacturing despite the crucial role of tightly integrating research and development with manufacturing in fostering innovation. It would be an objective determination to assume that Wall Street's favored metrics has impeded innovation. Criticism from scholars and executives alike has targeted Wall Street for not only promoting short-term thinking but also for prioritizing shareholder benefits at the expense of employees and customers. This influence has even led executives to engage in dishonest practices as they feel pressured to meet unrealistic demands. The financial sector's sway over management has become so formidable that a recent survey of chief financial officers revealed that 78% of them would willingly sacrifice economic value, and 55% would cancel a project with positive net present value, essentially harming their own companies to meet Wall Street's targets and fulfill its expectation of consistent earnings. Executives often justify their deference to Wall Street by invoking a fiduciary duty to maximize shareholder returns. This belief has been ingrained since 1970 when Milton Friedman argued in the New York Times that executives' sole responsibility was profit maximization. However, the problem lies in the fact that this notion is not accurate. Regardless of personal beliefs about executive moral obligations, a fiduciary duty is a specific legal obligation, and legal scholar Lynn Stout has demonstrated that, as a matter of law, American executives do not bear such a requirement. So why do managers make choices that they know are flawed? Why do so many individuals believe or act as if they believe in something that is fundamentally incorrect? As a political scientist, my focus revolves around power, much like economists analyze money and soldiers evaluate armies. There are numerous situations where people and even entire societies act against their own interests. One of the most significant, and perilous, occurrences transpires when a single sector or group holds such immense power that it shapes the collective mindset of an entire society. When viewed through this lens across various research fields, it becomes evident that measures must be taken to curb the excessive and disproportionate power of Wall Street. Prior to the Great Depression, financiers held such elevated status and influence that when Theodore Roosevelt filed the first significant antitrust lawsuit against J.P. Morgan's railroad, Morgan arrogantly suggested, and I quote, "If we have done anything wrong, send your man, the Attorney General, to my man, and they can fix it up." However, following the stock market crash of 1929, the United States enacted the Glass-Steagall Act and other regulatory measures to rein in the financial sector and promote stability. Unfortunately, over the past few decades, much of this legislation has been dismantled, leading to profound consequences. The most evident outcome has been the staggering growth of the financial sector. In 1970, finance and insurance industries accounted for 4.2% of the U.S. GDP, up from 2.8% in 1950. By 2012, this figure had risen to 6.6%. Profits tell a similar story. In 1970, finance and insurance industry profits were equivalent to 24% of all other sectors' profits combined. In 2013, despite the lingering effects of the financial crisis, that number had surged to 37%. These statistics, however, do not fully capture finance's overwhelming dominance since numerous non-financial firms possess significant financial units. The assets of these units began a sharp ascent in the early 1980s and, by 2000, had equaled or exceeded the tangible assets of non-financial corporations. For instance, during the early 2000s, Ford made more money from selling loans than from selling cars, while GE Capital generated approximately half of GE's total earnings. When including non-financial corporations, the total value of U.S. financial assets was 5 times the country's GDP in 1980 and 10 times the GDP in 2007. The growth in size and profits has also amplified finance's influence on the government. Between 1998 and 2013, the finance, insurance, and real estate sectors spent nearly $6 billion on lobbying, second only to the healthcare industry. In the aftermath of the 2008 crisis, the financial sector intensified its pressure on the government. For example, during the 2013 and 2014 election cycle, finance, insurance, and real estate spent almost $485 million on lobbying, surpassing all other industries, and contributed nearly $149 million to federal candidates' campaigns, nearly 3 times as much as the healthcare sector. The intertwining of representatives and lobbyists from the financial sector with the regulatory agencies meant to oversee them is so pervasive that they are collectively referred to as the blob in Washington. This is evident in the career backgrounds of current and former government officials. One key position is the Treasury Secretary. Let's consider the past 6 individuals who held that office. Jack Lew, the current secretary, previously worked at Citigroup. His predecessor, Timothy Geithner, now serves as the president of Warburg Pincus, a Wall Street private equity firm. Geithner's predecessor, Hank Paulson, was formerly the CEO of Goldman Sachs. Prior to Paulson, John Snow, who currently chairs Cerberus, a private equity firm, held the position. Snow's predecessor, Larry Summers, received over $5 million from the hedge fund D.E. Shaw after leaving the Treasury, and Robert Rubin, his predecessor, also held leadership positions at Goldman Sachs and Citigroup after leaving the government. My research underscores that leaders' career trajectories significantly shape their actions in office. Individuals who have spent their careers deeply immersed in the financial sector are highly likely to adopt its worldview. Each of these 6 individuals either had extensive financial sector careers before joining the government or displayed enough sympathy toward the sector's interests while in office that securing a high-ranking and well-compensated position within it after leaving the government posed no challenge, or both. As former Federal Deposit Insurance Corporation chairwoman Sheila Bair explained, the issue is cognitive capture. It's not merely about corruption, but rather about excessive deference to large financial institutions and their representatives, with insufficient consideration given to the concerns of everyday citizens on Main Street. The influence of Wall Street on policy remains extraordinary, even after the financial crisis. Here are 3 examples illustrating this influence. First, Wall Street successfully worked to delay the enactment of the Volcker Rule, which aimed to prevent banks from using federally insured deposits for their own trading purposes. Lobbyists representing the financial industry, advocating for weakening the rule, dominated the meetings with regulatory agencies, accounting for 93% of the outside party meetings leading up to the draft of the rule. Another example is the lobbying blitzkrieg launched by Wall Street in response to the Commodity Futures Trading Commission's attempt to regulate derivatives, which played a significant role in the crisis. The result was a series of exemptions that limited the CFTC's regulations to covering less than 20% of the global market. Lastly, Attorney General Eric Holder testified before Congress that he refrained from prosecuting some banks due to their size, as charging them could harm the economy. This testimony implied that these banks were considered above the law due to their immense power. The finance industry has experienced a resurgence in prestige, reaching levels comparable to the 1920s. Following the implementation of the New Deal, Wall Street lost its appeal and was considered less influential. In 1949, Peter Drucker noted that graduates from Harvard Business School, who previously aspired to work at New York Stock Exchange firms, were now seeking employment in steel, oil, or automobile companies. However, the scenario changed drastically by 2012 when J.P. Morgan and Goldman Sachs ranked among the top 10 most coveted employers globally. That year, 35% of Harvard Business School graduates pursued careers in financial services, albeit a decrease from the peak of 45% in 2008. Let's now talk about what financialization is and what it means. Financialization refers to the growing influence of financial markets, institutions, and privileged groups over various aspects of the economy and society, including the government. This phenomenon is not exclusive to the United States, as demonstrated by historical instances analyzed by sociologist Giovanni Arrighi and others. These instances include Spain in the 14th century, the Netherlands in the late 18th century, and Britain in the late 19th and early 20th centuries. Notably, the Dutch and British societies during their periods of financialization observed and deliberated upon the transformation of their economies. Strengthened by their increasing wealth, the financial elites of both countries successfully advocated for prioritizing finance as the foundation of their future. For instance, in 1925, the British government opted for a strong pound policy to benefit the financial services industry, rather than pursuing a weaker pound that could have stimulated British manufacturing. In a financialized economy, the dominance of the financial sector can have detrimental effects on the overall economy. Research conducted by the International Monetary Fund has revealed that while a strong financial system is crucial for early and intermediate stage growth of a country, once the sector becomes excessively large, with private sector credit reaching 80% to 100% of GDP, it actually hampers growth and increases volatility. This was evident in the United States in 2012, where private sector credit amounted to 183.8% of GDP beyond its impact on individual companies like Boeing. Financialization undermines economies in two significant ways. Firstly, larger and more complex financial systems are more susceptible to crashes. This point has been emphasized by various economists, including Hyman Minsky, Charles Kindleberger, and Raghuram Rajan. As early as 2005, Rajan famously argued that the risks of financial instability were much higher than most economists believed, only to face dismissal from Larry Summers, who labeled him a Luddite for his skepticism towards financial innovation. Secondly, an excessively developed financial system may lead to misallocation of resources. Nobel Prize-winning economist James Tobin pointed out as far back as 1984 that a significant portion of the activities conducted by the securities industry had little to do with financing real investment. He expressed concern that a growing portion of resources, including talented individuals, were being directed towards financial activities that generated high private rewards but were disproportionate to their social productivity. Capital plays a significant role in the effects of financialization, as highlighted by economist Oscar Orhangez's studies. As financialization increases, investment in real assets is often crowded out by investment in financial assets. This occurs because markets tend to favor short-term and easily liquidated assets, while non-financial corporations face mounting pressure to prioritize investor payouts, primarily through dividends or stock buybacks, rather than investing in tangible assets. However, the issue of resource misallocation extends beyond capital, as noted by Tobin. It also encompasses human resources. British economist Roger Boodle argues that all economic activities can be categorized as either creative or distributive. Creative work contributes to society's wealth by generating new value, whereas distributive work merely transfers wealth from one entity to another. Both types of activities exist within every industry, including the financial sector, but the primary nature of the financial services industry is distributive. Furthermore, the financial services industry exhibits a high level of a particular type of distributive activity known as rent-seeking, which involves seeking profits through the manipulation of government policies. Economists have demonstrated that when a nation's most productive workers transition from entrepreneurial endeavors to rent-seeking activities, economic growth slows down. Wall Street, in particular, attracts some of the brightest minds in America, but unfortunately, many of them end up engaging in wealth distribution rather than wealth creation. The presence of brilliant computer scientists or engineers dedicated to shaving fractions of a second off high-frequency trades means they are not contributing to, or founding companies like Google, Amgen, or Tesla that have the potential to drive true innovation and economic growth. Another perspective on this issue can be examined at the transaction level. In certain industries, the majority of transactions result in a positive sum outcome. For instance, when you purchase a car from Ford, ideally, both you and Ford benefit a year later. You value the car more than the money you spent, and Ford values the money more than the car. However, when it comes to buying and selling stocks, the outcome is typically zero-sum. If I sell you a share of stock, one of us is likely to be pleased a year later depending on whether the stock price has risen or fallen. While much of the financial sector, such as retail and commercial banking, insurance, and venture capital, engages in positive sum transactions, many segments that have experienced rapid growth since deregulation, such as investment banks, primarily involve zero-sum transactions. Compensation within the financial sector also reflects the industry's significant influence. Economists Thomas Philippon and Ariel Reshef discovered that before the Great Depression, financial workers earned considerably more than those in other sectors, even after accounting for their higher level of education. Following the passage of Glass-Steagall in 1933, this premium diminished rapidly, and by 1980 it had disappeared. However, after deregulation, the trend swiftly reversed, and by 2006, the premium had returned to its pre-depression level. The wage premium within the financial sector was substantial across the board. In 2006, on average, finance employees earned 50% more than equally well-educated employees in other sectors of the economy. However, for senior financial executives, this premium reached staggering levels. They earned a remarkable 250% more than their non-financial counterparts. The gap was even more significant for senior executives on Wall Street, who made a remarkable 300% more than their counterparts in non-financial industries. When assessing the overall impact, depending on the calculation method, The wage premium within the financial sector contributed to 15% to 25% of the overall increase in economic inequality in the United States since 1980. Thus, we find ourselves examining a sector that performs essential functions, as no modern economy can exist without banks. But when it grows excessively, it tends to hinder economic growth, exacerbate inequality, and experience devastating crashes that impose significant costs on society, as seen in the aftermath of the 2008 financial crisis, which incurred over $2 trillion in lost tax revenues and increased government spending. Despite these drawbacks, the financial sector wields substantial influence over the broader economy, even though many managers are aware that its demands are detrimental to their own companies. This brings us back to the initial question raised in this article: why do societies and individuals act against their own interests? The answer can be summarized in 2 words: imbalanced power. Just like how the gravitational pull of a black hole can alter the orbits of stars situated light years away, great power and prestige have the ability to shape the behavior of those around them, both directly and indirectly. Direct influence operates through coercion and inducement, where compliance is rewarded and disobedience is punished. We witness direct power in action every time political donations sway the voting decisions of politicians. Indirect influence, although less apparent, is even more significant. True power arises not from forcing people to do one's bidding, but from altering their mindset so that they want to do what the powerful desire. The famous saying by Lord Acton, "Power tends to corrupt, and absolute power corrupts absolutely," is often interpreted as an observation about the effects of power on those who possess it. However, Acton was actually referring to the impact of power on our perceptions of the powerful. There is a natural inclination to believe that those with power are virtuous, just, and acting in the best interest of all. Power and prestige can create an illusion of benevolence surrounding the actions of those who possess them. The ability of a powerful group to reward conformity and punish dissent also distorts the marketplace of ideas. This is not necessarily about corruption. Rather, it is a natural consequence of beliefs shifting in accordance with one's interests. As Upton Sinclair stated, it is difficult to get a man to understand something when his salary depends on not understanding it. The result is an entire society contorted to serve the interests of its most powerful group, further perpetuating and reinforcing the power dynamics in a destructive cycle. This phenomenon can occur even when the stakes are exceedingly high. For instance, prior to World War I, virtually every aspect of German society was dominated by the military and the industries supplying it. Driven by a desire to rival Britain's colonies and the prestige associated with the Royal Navy's supremacy, Germany's military establishment sought to build a navy capable of challenging Britain's, despite the relatively amicable relationship between the two nations. To achieve this, the German Navy provided subsidies to the Navy League, an organization dedicated to exerting pressure on the government for increased naval budgets, and established a news bureau to influence the media. Prominent academics, including Max Weber, one of the most renowned sociologists and political economists of his time, were recruited by the Navy to tour the country and advocate for its interests. The outcome was a significant surge in the naval budget, further consolidating the Navy's influence over German industry. The consequences of this imbalanced power were catastrophic. Britain perceived Germany's growing navy as an unacceptable threat and forged alliances with France and Russia. When World War I erupted, the expensive German battleships proved to be of little significance, and Germany turned to submarines as a means to weaken Britain. However, this strategy drew the United States into the war, ultimately sealing Germany's defeat. The lopsided power structure in Germany compelled the country to allocate immense resources towards an asset that not only lacked value but also had negative value, as it drove Britain and the United States into the arms of Germany's adversaries. In the United States, it is the financial sector, particularly Wall Street, that wields disproportionate power instead of the military. Undoubtedly, a robust financial sector is essential for the country, as it serves as the economic circulatory system. Without it, capital cannot flow to where it is needed. However, the large banks that have propelled the astonishing growth of the finance industry have become an enlarged heart that weakens the very body it is intended to sustain. In fact, it has reached a point where the financial sector is unable to fulfill its fundamental functions. The American economy is currently suffering from the consequences of this enlarged heart. So, we reach the point where we must ask ourselves, how do we fix the problem? Well, we need to bring the system back into balance. Because the financial sector's power and prestige are products of its extraordinary size and profitability, We need reforms that reduce those to healthy levels without inhibiting the sector's critical functions. The key is to choose reforms that counteract the distortions created by finance's power, reforms that are worthwhile for purely economic reasons. They will be fought because they reduce the profitability and power of some in the financial sector. But that's the point. Reforms that don't do that won't work. The idea that economic policy should consider power is almost as old as the United States. It goes back to Washington's first cabinet and the rivalry between Jefferson and Hamilton. The two had different views of how the American economy should evolve, but those views were shaped as much by their beliefs about what would foster democracy as by what would generate wealth. In the 20th century, the antitrust thinking of Louis Brandeis, one of the key inspirations for Glass-Steagall, stemmed from his apprehensions about the influence and power that large financial firms could gain over both industry and government. Here are a few potential approaches to this sort of reform. We can limit the size and leverage of banks. Following financial deregulation, the largest banks in the United States experienced rapid growth, which only intensified after the financial crisis. In 1995, the assets of the 6 largest U.S. banks accounted for approximately 17% of the country's GDP. By 2006, that number had surged to 55%, and by 2013, it had further increased to 58%. The presence of these big banks results in a significant indirect subsidy from the government. The market operates under the belief that their debts are implicitly backed by the government, leading to lower borrowing costs for these banks. In 2012 alone, this subsidy was estimated to be worth around $70 billion, equivalent to 2.5% of the total federal tax revenues, benefiting the 8 largest U.S. banks. To minimize both the power wielded by these banks and the subsidy they receive, it is crucial to ensure that they remain small enough for the government to allow them to fail. In their book 13 Bankers, Simon Johnson and James Kwok propose a solution by suggesting that the assets of universal banks, which encompass both commercial and investment banking, should never exceed 4% of GDP. Additionally, they recommend setting a ceiling of 2% for investment banks. While this approach would only impact a few companies, these few wield tremendous power within the financial system. Implementing such measures would help curtail their influence and reduce the subsidy they receive. Banks have further expanded their power by increasing their leverage, which amplifies their profits but also escalates their risk. The higher the leverage, the more susceptible they become to catastrophic consequences from even minor errors. When banks anticipate government bailouts, this risk is effectively shifted onto the public. It is evident that such a system, where risks are spread across society while gains are concentrated in the hands of a few, poses significant problems. However, the formidable political influence of banks has impeded regulators from taking necessary action. In their book The Banker's New Clothes, economists Anat Admati and Martin Hellwig demonstrate that imposing a cap on bank leverage could address this issue. By limiting bank leverage to a ratio of 3-to-1, wherein shareholder equity comprises at least 1/4 of total liabilities, banks would still retain their ability to provide loans while greatly enhancing the stability of the financial system. This approach offers a viable solution that would improve the resilience of banks without hampering their lending capacity. Another thing we can do is put debt and equity on a level playing field. Debt markets significantly outweigh equity markets in size, and debt carries inherent risks that equity does not. The level of indebtedness of a company directly correlates with its vulnerability to the fluctuations of financial markets. CEOs who strive to build exceptional companies actively avoid excessive debt due to this very reason. However, the U.S. tax code currently favors debt over equity by allowing tax deductions for interest payments but not for dividends. This effectively subsidizes debt at the expense of equity. Coupled with the high corporate tax rate in the United States, this creates a strong incentive for companies to borrow excessively. By eliminating the debt subsidy, we can reduce the financial sector's influence over the broader economy. My colleague Robert Posen proposes a solution of limiting these deductions while simultaneously lowering the corporate tax rate, offering a means to decrease the power imbalance within the financial sector and promote a more balanced economic environment. We can also increase the tax on financial transactions. The financial sector benefits from the vast number of financial transactions taking place in today's capital markets, which generate both power and profits. However, when considered collectively, these transactions impose significant costs on society as a whole, such as slower economic growth and the need for occasional bailouts, which are not shouldered by the participants themselves. One approach to address the negative impact on society is to implement a tax on these transactions. Furthermore, the low cost associated with trading shares encourages investors to adopt a short-term perspective, treating them primarily as financial instruments rather than long-term investments. Introducing a financial transaction tax, an idea initially proposed by Keynes in 1936 and implemented for currencies in 1972 by Tobin, would help reduce market volatility, encourage investors to adopt a longer-term focus, and weaken another source of power held by the financial sector. Currently, 40 countries have implemented such a tax, and the United States had a similar tax in place from 1914 to 1966. Lastly, another way we can start fixing the problem is by treating investment income like ordinary income. Another way in which the financial sector benefits from subsidies is through the lower tax rate on capital gains. While this tax preference is intended to promote investment and economic growth, studies by economists Leonard Berman and the Congressional Research Service have shown no correlation between capital gains tax rates and U.S. economic growth. As a result, individuals who derive their income from investments retain a significantly larger portion of their earnings compared to those who rely on labor income. This disparity in after-tax income further increases the power and prestige of those in the finance industry, as well as executives compensated through stock options, based on the flawed belief that maximizing shareholder returns is their sole responsibility. Why should the government subsidize financiers and senior executives at the expense of scientists and soldiers when there is no tangible economic benefit? This policy, based on a plausible but flawed theory that favors an elite group, exemplifies the distorted thinking that arises from an imbalance of power. Over the past generation, the U.S. financial sector has experienced tremendous growth, enriching its most powerful members while exerting influence over businesses and government. Unfortunately, the financialization of America has overshadowed and hindered the crucial work done by the majority of individuals in the sector, ranging from retail and commercial bankers to venture capitalists and insurance adjusters. Non-financial businesses must prioritize restoring balance. Power can only be countered with power, and despite the strength of Wall Street, the businesses that comprise the rest of the economy hold far greater power. It is entirely consistent to believe that most markets are overregulated while recognizing that financial markets require additional regulation. Financial markets are distinct from other markets and should be treated accordingly. If the American business community mobilizes, acknowledging that financialization hampers their success, it can become a formidable force advocating for financial reform as vigorously as any other issue crucial to their competitiveness. Pushback from non-financial businesses has already begun. Companies that utilize aluminum lodged complaints, leading to a Senate hearing and a Federal Reserve review of a 2003 ruling that allowed banks to trade physical commodities. As businesses recognize that this is merely one example of a broader problem, they should strive for financial reform with the same determination they would for any other issue critical to their competitive advantage. Leadership is equally crucial in effecting change. Leaders, especially presidents, have the power to reshape the political discourse and shift the entire country toward a new and improved political equilibrium. Following the 2008 crisis, the financial system may have been too fragile to risk implementing the reforms described here. However, by 2013, the system had recovered sufficiently that the average Wall Street bonus reached its highest level since 2007, amounting to $164,530. Nevertheless, we continue to face persistent unemployment, sluggish economic growth, stagnant median incomes, and other indicators of a wounded economy that has persisted for so long that it threatens to become the new normal. It doesn't have to be this way. Roosevelt's response to J.P. Morgan's offer to fix it up was unequivocal: that can't be done. His attorney general explained, "We don't want to fix it up. We want to stop it." 2 years later, Roosevelt's administration dismantled Morgan's trust, even though Morgan possessed far greater power than any modern financier, potentially controlling up to 40% of all U.S. capital. However, that did not deter Roosevelt from taking action. The current approach is not effective. Even before the crisis, the real estate bubble masked deeper issues within the economy. Today, it is evident to everyone that the economy is failing to deliver the jobs and incomes that Americans expect and deserve. We have the ability to rebalance our society and unleash U.S. companies' inherent talent for creating wealth that benefits every American. In the end, we have the power to bring change, and it is important to talk about these things with each other so we can strive for a better future. Thank you for watching this video to its end. Let me know what you thought of it below. Join my Discord if interested in getting the best day trading alerts, and I will see you guys again sometime this week with another video. Until then, have a great rest of your day and to the moon.